Buddy, today I want to do a technical analysis on the S&P 500, the healthcare sector, the tech sector, and the financials. And at the end, I want to go over a trade structure that I'm looking at going into next week and how we're going to build out throughout that trade structure. Because trade structure is pretty important. If you look over the past 2 months, we've probably done 80 trades on this channel. None of them have been losers. Because we've been able to come up with proper trade structure, even though we might be wrong on direction 20% of the time. And most people are only right on direction 60, maybe 70, maybe 80% of the time. So you need to come up with a trade structure where you make money 95% of the time or more. And if you're wondering about those trades over the past 2 months, go ahead, look at the previous videos. It's all public, it's all out there. You can look at the last video, the video before that. All of our trades are out there. We have had many trades where if you put them on at the right time, you took them off at the right time, managed winners correctly, and you would have had a 10-bagger in front of you within just a week. So go ahead, take a look at those trades. They're all in the previous videos. But when I look at the S&P 500, the first thing that I see, just from a technical perspective, fundamentals, I'll talk about that in a different video, but from a price action perspective, the first thing that I see is obviously looking very bullish right now. The very first thing that I see, though, is that we have a gap up here, and we have resistance right here. So this area from right here to right here, it's a supply zone, meaning some people call it a resistance zone, some people call it a supply zone. It's all the same thing. It's essentially an area where people are putting a lot of limit orders. People who got in right here are putting a lot of limit orders to get out right here. But also people who want to get short are putting a lot of their limit orders to get short right here. So this is a supply zone. I'll just mark that right there, supply zone. So just watch out for that right there. Not the cleanest S, but supply zone right there. Essentially, that doesn't mean the bulls aren't able to get up there. It doesn't mean that the price can't get through. It simply means that it's going to have to grind up through there. There are a lot of bullish signs though for this market. If you look at the amount of funds that are in the market and there aren't in the market, you tend to see a situation where most mutual funds, long-only funds, pension funds, longer-term fund vehicles that look out a couple of years usually look at things like the 200-day moving average, which is right here, and they always want to buy stocks above it, not below it. Here's the thing though, the market sold off so quickly that if they had used a 200-day moving average, they would have essentially just lost money. Because 200-day moving average didn't really move. And from the spreads, commissions, and them probably getting out late, they probably lost a good amount of money doing that. And many others rely on things like death crosses and golden crosses. That's when the 50-day moving average crosses the 200-day. That happened all the way down here. This is a 50-day right here. This is a 200-day. They crossed right here. They would have got out at the very market bottom. And that's because when the market dropped, it dropped so quickly and it recovered so quickly. But I got to say this is a bullish market and there's going to be more money coming in. All of the buyers who have bought up so far, they're short-term momentum buyers. The long-term, long-only funds, mutual funds, pension funds, they have not bought in yet. They're still in cash. And I think as it starts to go higher, they will finally start to buy in once again, and their traditional ways of getting out, such as the 200-day moving average, the 50 and the 200-day crossing over, those have not worked because the market dropped so quickly and then it recovered so quickly. I do think, though, that we could probably get to 3,500 by the end of June. Another thing to look at is that you have a lot of gaps in the chart. So if we actually zoom in, we have a gap right here. We have a gap right here. And intraday, if you were actually looking, over the last week and the week before that, you would see that the market got to the gap and then it bounced. And that's very abnormal. I've been saying this, and the term was coined by Peter Resnick, but we've been saying that when what should happen doesn't happen. What should happen is that it should fill the gap and then it should continue higher. It did not fill the gap. And that's a sign that's very bullish in the short term. So short term meaning the next month and a half, but long term, the next 6 months, it's actually very bearish because when the market does top out, which it will at some point, and then when it starts to come down, it's going to come down really quickly because there's no support because the gaps have never gotten filled. So that's something important right there to keep in mind. But here's the thing. After it gets through the supply zone, I think it's going to follow this trend line. After it gets through the supply zone, it's going to go higher, and I think it's going to rip higher. So it's slowly going to grind up, and then I think that it just rips higher from here. Probably not straight up, but it rips higher probably in a week or two. And that's because after this resistance line right here, after the supply zone is done, you have this area right here, and then you have the area above it right here. Now this area right here has no resistance, and then you have a big gap right here. Gaps have no resistance, and then you got all-time highs. So getting the all-time highs wouldn't be that hard. I think 3,400 is not that hard to get to. So it looks very bullish in the fact that it's not filling gaps, and on the upside, all you have is the 3138 resistance, and then you go straight up from there. And so just watching the supply zone right here, but I think it will grind higher through there, and then from there it will fly higher. So I want to take a look at XLV, the healthcare. So it has broken above resistance, resistance broken above. Watch all-time highs, see if it triple tops on all-time highs, and then if it pulls back. Most of the time when it's going to break it, it goes up, and then it pulls back, comes down here, and then it breaks and then goes higher. That's usually how it usually goes. Touches the resistance point, has a bit of a pullback, and then from there goes higher. Even if it touches resistance point and then it comes down and it doesn't go higher, all it's going to do is it's going to chop here sideways and it's going to consolidate for probably another 2 weeks before it even has a chance to go bearish. So bearish is the last thing I'm thinking right here. And this is one of the weaker sectors. XLK Tech. Okay, so looking at Tech right here filling the gap, I think it's going to fill the gap all the way up here. So short term filling the gap all the way to 98.42. So 98 spot 42 filling the gap, and from there I think it probably will hit some resistance right here, maybe have a bit of a pullback, and then from there it will go higher to all-time highs. Look for a double top right there. Again, another pullback, higher low, and that's likely to continue higher. Again, even if it hits the resistance and then it comes back down and then it doesn't come back up, it's likely just going to go through an equilibrium tightening range pattern where it's just going to consolidate sideways, probably another week or two. So I think the least likely scenario, because markets don't just go up and then come straight down. They usually go up, trade sideways, or chop sideways, go in a tightening range, maybe go in a tightening range for 2 weeks like this right here. But they don't just come straight down. Or if they do come down, they will slowly go like this. And so unless you have some big exogenous shock, I just don't expect it to fly straight down like this. And then the most bullish, XLF. So there's one thing that the XLF bulls need to do. You got this point right here, you got this point right here. The XLF bulls, they break out, and then whether it's a breakout or a fake out is known by one way, and that is if it's going to pull back, and then it's going to continue higher. It has done the pullback part, and then it needs to continue higher. If it just pulls back and it doesn't do anything, that is a fake out. And you just act as if this was a resistance point that it hit and it came back down. And that's still within this range. If it comes back down and then it goes up, and then yes, I would expect it to go higher into a breakout. And then right here, you got a gap right here. This area doesn't have too much resistance, some resistance right here. But gap right there, you have some pretty big gaps in the chart. Gap up here. The only area is this little block right here. That would be a supply zone. Other than that though, if they can get above this level right here, resistance point, and actually break higher, and also get above this previous level, I think that we're going higher and we're filling all these gaps right here. So that's what I'm expecting on all the sectors, or at least the 3 main sectors. There's so many sectors that make it up. These are 3 main sectors that you should be watching for right now that have a large weighting. How do we want to structure this trade? So SPY long June 29, 2020 strike 321 calls for 125. They were 135 earlier, now they're only 125 because the market has done a gap down open. But I think this is a good way to go about it. So you just start with these long calls that expire 4 weeks from now. Then in a week after the market has already gone up, then you turn into a calendar spread and sell a call against a call you own, same strike. Then after another week of going up, you then turn into a diagonal spread, and then after another week of going up, you turn into a vertical spread. So doing a trade structure where you slowly leg in and collect some premium on your long calls, I think are a good way to go about it. But We'll look at that later on in a week. We'll reassess it, but that's just what I want to do right now. If you have any questions about the options trade right here, the way we want to structure by turning into a calendar spread, then a diagonal spread, then a vertical spread, actually start to leg into things, because that's how we usually like to go with things. Instead of just buying or selling it, we usually like to slowly leg in. And that's the way that we usually like to go about things, is to leg into spreads. So start with a naked option, then slowly leg into a different spread from there. So if you have any questions about that trade, or if you have any questions about what we said about XLF, XLV, XLK, anything that we said about the S&P 500, just go ahead and ask us. I'm on YouTube, I'm on StockTwits, I'm on TradingView. There's a lot of different places where I'm on. Go ahead and ask me right there. Other than that, happy trading.